SaaS churn is one of the most underestimated threats in the entire software industry, yet it has the power to quietly destroy even the fastest-growing businesses. Many SaaS founders obsess over growth charts, new signups, and monthly recurring revenue, believing that as long as the top line is moving upward, everything is fine. But churn works in the background, silently eroding the foundation of the business. When churn is ignored or misunderstood, it doesn't just slow growth, it can completely kill the company. At its core, churn is the percentage of customers who stop paying for a product over a given period. In a subscription-based business, this metric is deadly serious. Unlike one-time sales models, SaaS depends on customers staying month after month, year after year. The moment customers leave, future revenue disappears. There is no second chance to monetize them unless they return, which is rare. What makes churn especially dangerous is that it compounds over time. Losing a small percentage of customers each month may seem harmless, but over the course of a year, it can wipe out a massive portion of the customer base. A business losing 5% of its users monthly will lose nearly half of them within 12 months. That means the company is constantly running uphill just to stay in the same place. High churn turns growth into an illusion. A SaaS company might report impressive new customer acquisition numbers, but if customers are leaving at nearly the same rate, real growth is non-existent. This creates a false sense of success. Leadership feels confident. Teams celebrate signups. Marketing looks effective. Meanwhile, the business is leaking value faster than it can create it. The most brutal impact of churn is on customer lifetime value. In SaaS, profitability depends on how long customers stay. The longer a customer remains subscribed, the more revenue they generate relative to the cost of acquiring them. When churn is high, lifetime value collapses. Suddenly, acquisition costs are never recovered, and every new customer becomes a loss instead of an asset. This is where many SaaS businesses unknowingly sabotage themselves. They invest heavily in paid ads, outbound sales, partnerships, and promotions to acquire customers. On paper, the numbers look aggressive and ambitious, but when customers leave after a few months, the business never earns back what it spent to acquire them. The entire model breaks. Churn also places constant pressure on marketing and sales teams. Instead of building on past success, these teams are forced to replace lost revenue over and over again. Every month feels like starting from zero. This creates burnout, inefficiency, and a culture focused on short-term wins instead of long-term value. Investors understand the danger of churn extremely well. High churn is one of the biggest red flags in SaaS investing. A company growing at 100% year over year with terrible retention is far less attractive than a slower growing company with loyal customers. Strong retention signals real product market fit. Weak retention signals a temporary illusion. Another reason churn is so destructive is that it impacts revenue from multiple angles at once. When a customer leaves, recurring revenue disappears immediately. Expansion revenue is lost. Upsells and cross-sells vanish. Referral potential disappears. The ripple effect extends far beyond a single cancelled subscription. Churn also damages pricing power. When customers frequently cancel, companies often assume the product is too expensive. In response, they lower prices, offer heavy discounts, or extend free trials. While this may temporarily slow churn, it often attracts even worse fit customers and further reduces margins. Instead of fixing the underlying value problem, pricing becomes a dangerous distraction. In reality, most churn is not caused by price. Customers leave because the product fails to deliver ongoing value. They may have been excited at sign-up, but over time the product becomes irrelevant, inconvenient, or replaceable. If the value is not clearly felt on a regular basis, the subscription becomes an easy expense to cancel. Poor onboarding is one of the biggest contributors to churn. If users don't experience meaningful value quickly, they never build a habit around the product. They may stay subscribed for a few months out of hope or inertia, but they were mentally gone from the beginning. Many SaaS products lose customers before those customers ever fully engage. Misaligned customer acquisition is another major churn driver. When marketing attracts users who are not a good fit, churn is guaranteed. These users may sign up because of aggressive messaging, discounts, or hype, but they never truly needed the product. Growth fueled by the wrong customers always shows up later as churn. Customer success is often treated as an afterthought, especially in early-stage SaaS companies. Founders focus on building features and closing deals, assuming customers will figure things out on their own. But without guidance, education, and proactive support, many users fail to reach the product's full potential and eventually leave. Churn doesn't just hurt revenue, it hurts teams. Sales teams feel frustrated replacing lost accounts instead of growing existing ones. Support teams deal with unhappy users who are already halfway out the door. Product teams get conflicting feedback from short-term users instead of insights from long-term customers. The entire organization becomes reactive. Financial planning becomes extremely difficult when churn is high. One of the biggest advantages of SaaS is predictable recurring revenue. Churn destroys that predictability. Forecasts become unreliable. Hiring becomes risky. Long-term investments feel dangerous because future revenue is uncertain. High churn can also hide deeper product-market fit issues. A company might boast thousands of customers, but if most leave quickly, the market is clearly rejecting the product. Without closely tracking retention and cohort behavior, leadership may believe the business is healthier than it actually is. As a SaaS company scales, churn becomes even more dangerous. Customer acquisition channels get more expensive. Competition intensifies. Differentiation becomes harder. If churn remains high, growth slows dramatically because replacing lost customers becomes increasingly costly. The most successful SaaS companies obsess over retention for this exact reason. Businesses like Salesforce, Slack, and Zoom built massive businesses not just by acquiring users, but by keeping them for years. Retention turned growth into momentum. Low churn creates powerful compounding effects. Revenue stacks on top of itself. Customer relationships deepen. Expansion revenue grows naturally. Marketing becomes more efficient through referrals and brand trust. Each retained customer increases the value of the entire ecosystem. High churn creates the opposite effect. Every month feels like damage control. Growth becomes fragile. The business becomes dependent on constant acquisition instead of lasting value creation. Even small disruptions can cause major declines. Churn also limits innovation. When customers don't stick around, it's hard to gather meaningful long-term feedback. Product teams end up chasing short-term fixes instead of building durable solutions. Vision gets replaced by urgency. Even modest improvements in churn can completely change a company's future. Reducing monthly churn by just 1 or 2 percentage points can double customer lifetime value. That single improvement can turn an unprofitable SaaS business into a sustainable one without spending an extra dollar on marketing. Understanding churn requires nuance. Not all churn is equal. Some customers leave early because they were a poor fit. Others churn later because their needs evolve. Some leave due to poor onboarding, while others leave because they outgrew the product. Treating all churn the same leads to poor decisions.